Hi traders, welcome to today's video. My name is Marco Mayer from Trading Educators and AlgoStrats, and today I'm going to talk about the major differences between trading spot forex versus currency futures. So first of all, this is no advice on what kind of instruments you should or should not trade. It's just my personal view on what the major differences are in my opinion, the advantages and disadvantages that matter for myself, and just what I've learned from my experience of trading both of these instruments. There are a lot more nuances you should know about by reading in detail about each of the products, and what I'm going to explain here will in no way be exhaustive and all-inclusive. So let's start with looking at the differences regarding the regulation. Now in the past in the Forex this really has been a big issue because most brokers have not been regulated at all. Nowadays, this is a lot different. A lot of things have changed here to the positive side. And in the futures market, it's still better because there's a higher regulation going on there, especially on the exchanges, but also at the brokers. In Forex, most brokers and ECNs nowadays are pretty well regulated. And nowadays, there's also LMAX exchange, which is FCA regulated. And that's where I'm doing my Forex trading at the moment. There's still frauds and backed brokers out there, so you still need to be very cautious, especially if you're opening a Forex account in one of the countries that are not well regulated. So do your research and select your broker very carefully, but things definitely improved here compared to 10 years ago. Now when it comes to transparency, futures still is at a big advantage here. It is a centralized market. There's one exchange, the CME for the currency futures. There's some other exchanges where you can trade currency futures too, but they are much less liquid and most of the trading is going on at the CME, and whatever exchange you choose for the contract you're trading, everyone going to see the same price quotes, maybe not at the same speed, but they're going to see the same price quotes. Everything is very transparent and fair. So futures probably is the most fair instrument out there you can trade. Now in Forex it's a decentralized market, which means there are many separate ECNs and lots of over-the-counter trading. Now one exception is the LMAX exchange, where everyone's going to see the same price quotes because it really is an exchange. So there's real transparency going on there and everything is as fair as in the futures from my perspective. But in general, when you're trading on an ECN or at a market-making broker, things are different here. So in Forex, you might get different quotes on different brokers. For example, you have different spreads for sure. You have different liquidity. So you're not trading the same market actually. Now, when it comes to liquidity in the futures, it highly depends on what contract you're trading and what time of the day you're trading. So if you, for example, trade the Euro future, that's a contract that's highly liquid most of the time, most of the day. But if you want to trade the Euro-CAD cross future or the mini or micro-sized contracts, that can be quite expensive, especially during non-US trading hours, where liquidity goes down, the bid-ask spread widens, and you can experience really serious slippage there. Now in Forex, you're often told that it's the biggest market, it's a 5 trillion market, and it's the most liquid market out there compared to the futures. But that isn't actually really true, because if you're trading at a retail broker or at an ECN or even at LMAX exchange, you don't have access to that really big liquidity pool. Most of the trading in Forex is actually happening OTC, so it happens between banks and central banks, or just between central banks. Now you won't have access to that kind of liquidity trading at a market-making broker, for example, where the truth is you have only very limited liquidity most of the time, and quite often it's less than in the futures markets. But again, if you're using a good broker, trading at a good ECN or at LMAX exchange, you're gonna have plenty of liquidity on most trading hours. And once you're trading an account big enough that that's gonna worry you, then you can get access to the bigger liquidity pools and trade directly with the banks. Now when it comes to trading costs in the futures, in the standard contracts, the commissions are very low. For the mini and micro contracts, it's a bit worse. When it comes to slippage, it depends strongly on the liquidity of the market, of course, and that's very, very different between the Euro future and, for example, the New Zealand dollar, depending on what time of the day you're trading. In Forex, with a good broker or ECN, you're gonna have very low commissions. And the liquidity going on is mostly independent of the unit size you're trading. So yes, there might be some ECNs where if you trade in 1 million lots, you're going to get slightly better fills. But overall, you're going to get very good fills, even trading with small lot sizes. But you should be careful with market makers that charge no commissions per trade and tell you they have no commissions and only the spread. But the truth here often is that the spread is very wide and you're going to pay a lot more than if you would actually just pay a commission. So be careful here and do the math to figure out what's actually cheaper. Now the last point I want to talk about is lot sizes. And in the futures, that's not very flexible because you can only trade one lot. You can't trade like 1.5 lots or a quarter lot, and that doesn't provide a lot of flexibility, especially for small trading accounts. So in the Euro FX, for example, one contract means trading $125,000, which quite often is going to be too much if you have a small account. Now you can trade the mini and micro contracts, which are smaller, but if you do so, you're going to have higher trading costs due to the worse liquidity in these markets, which can be quite an issue depending on your trading style. Now in the Forex markets, you have very flexible lot sizes. This means that at most brokers and ECNs nowadays you can trade mini lots, which is 10,000 units, or micro lots, which is 1,000 units. So you could, for example, trade a position size of exactly $3,000 in the Euro-US dollar, or you could trade exactly $175,000 against the US dollar. You don't have to trade in 100,000 lots or something like that anymore. Now this can be really a big advantage, so let's have a look at why. Flexible position sizing really can be an edge. Now in the futures, to do really flexible position sizing, you need a quite large account. So for swing trading, we're talking about, in my opinion, 250,000 plus. In Forex, you can already profit from that with a small account because of the small lot sizes. And this allows you, for example, to do longer term trades with good risk management. It allows you to adjust your position size to changes in market volatility. You can use larger stops when it makes sense and you want to. In futures, you'll be quite strongly biased and pushed towards using often too tight stops if you have a small account, just because the risk is too high. And of course, it allows you to diversify, which really is an edge in my opinion, because you can have multiple positions in different markets at the same time, even if you have a small account. In Forex, you can just split up the risk by reducing your position size and trading, for example, 10 markets at the same time. And that also allows you to trade multiple systems at the same time without running against any risk issues, because you can just scale down the position sizes so that it works out fine overall in your complete portfolio. And if you're trading systems or different methods, that's really a big edge here. And it allows you to use more complex risk management models. You can consider your overall portfolio risk, adjust your positions accordingly, look at market correlations, and take full advantage of compounding, because you don't have to do a fractional position sizing like you often do in futures. Instead, you can really adjust it right away whenever your account size is growing. Another advantage in Forex is that you can easily build your own crosses. So instead of, for example, trading the Euro-Australian dollar pair, you can trade your own weighted cross by precisely defining what kind of weight you want on each side of the cross. So my conclusion is that both have their advantages and disadvantages. And at the end, the question is what you actually need for your trading, which instrument makes sense for you and your account size. So if you only want to day trade the major pairs during the US market hours, definitely have a look at futures in my opinion, because of the transparency going on there and the good liquidity around these market hours. But if you only have a small account, you might want to have a look at Forex, due to the more flexible position sizing, because it will strongly increase your odds, since you can do proper risk management instead of overtrading your account with futures, which is very often a quick road to disaster if you do that. And of course, if you want to trade the crosses, exotic pairs and so on, or you want to trade during the non-US market hours, definitely have a look at Forex. Okay, so thanks for watching. This week algostrats.com went online. So if you like, go there and check it out. You can also get in touch with me on Twitter and Facebook. And if you didn't do so, go ahead, subscribe to our YouTube channel at youtube.com/tradingeducators. So see you next time and take care.